Hi guys, and welcome back to my channel. Today, we are talking about investing in the stock market. If you want to learn about investing in general and different type of investments, you can watch this video right here where I break it all down by different asset classes and tell you the benefits as well as pitfalls of each of them. Why should you invest in the first place? Well, the culprit is inflation, which I talk more about in that video that I told you about earlier. But just to sum it all up, it's basically the decrease of the buying power of your money. So on average, every year, things cost 2% more. If you have any money under your mattress or in your bank account, it's losing value by 2% every single year. Yes, I know it's devastating, but that's life. There's nothing I can do about it. Well, there is actually. You can invest it. All investments carry some degree of risk. So before you invest, you need to do two things. One, you need to budget. You need to know where your money is going. The second thing is you need an emergency fund. An emergency fund covers 3 to 6 months of your expenses. So if anything happens, you will have enough money to last 3 to 6 months. If you're more conservative, I would increase the number of months. Otherwise, I would recommend having at least 3 months of expenses in an easy-to-access account. And please always invest the amount of money that you're comfortable with, especially in the beginning. Don't let anyone pressure you into investing in something that you don't understand or you don't feel comfortable with. Starting with individual stocks and shares. If you own a stock or a share, you own a slice of that company. For example, you can have a share of Apple, you can have a share of Tesla, you can have a share of Hermes. So every time Kylie Jenner posts a picture with a Birkin, you know that she's contributing to the company that you own. I really need to stop this thing with the Birkins because it's getting borderline obsessive. Investing in individual stocks is considered to be quite risky because you're putting all your eggs in one basket. So let's say you invest all this money into Tesla. If Tesla as a company goes down, you will lose all your money. Investing in individual stocks requires some deeper understanding and analysis of how the company operates, the balance sheet, different ratios, and other things like that. If you want a more in-depth video about how I pick the stocks and decide on what I buy, I can certainly do that. Just let me know in the comments down below. If you feel too intimidated by this process, don't worry, there's a more beginner-friendly approach. There are different types of funds. For example, mutual funds or index funds. We will start with mutual funds, as they've been around for the longest. They go back to 1800s as a way for people to pool their money together and make investments. You get to own a bunch of different companies in one package. So you can have a piece of 100 companies with only one purchase. And of course, you could buy 100 individual companies, but every time you buy an individual stock, you have to pay the trading commission, and you don't want to do that 100 times. With mutual funds, you pay it only once. They offer you diversification, so you put your eggs in different baskets. So for example, if one company goes down, there are 99 other companies to pick up the slack and cover for that one. Sounds great, right? But there's one thing. These funds are actively managed by investment professionals who supposedly know what they're doing, and they charge you very high fees, up to 2% of the account balance, for actively managing this fund for you. You have to pay this fee even if they make poor decisions and your portfolio goes down. You may think that 2% is not that bad, but these fees do really add up and become very significant over a long period of time. Even Warren Buffett criticized the hedge fund industry, which in his view charged exorbitant fees that the fund's performances couldn't justify. He even challenged the hedge fund industry to outperform the S&P 500 index fund over 10 years. This bet pit two investing philosophies against each other: active investing and passive investing. So what is S&P 500 index fund? And what is passive investing? We have index funds thanks to Jack Bogle, who was fed up with the high fees that fund managers were charging. Index funds are passively managed. So instead paying some expensive fund manager to do active management, the fund follows a fixed formula that completely eliminates the need for anyone to make the buying and selling decisions. So what really is an index? Index is a calculated average of many different components. For example, S&P 500 is an average of 500 biggest companies in the US, rolled up into one easy-to-read price average. We often say that indices are a representative sample of the stock market. Although there are more than 4,000 stocks in the US, the S&P 500 is a pretty accurate reflection of the overall US stock market because the largest and the most influential companies are part of the S&P 500 index. S&P 500 is not the market, but it is a representative chunk of the market. There are a lot of indices. And in fact, most developed countries do have one. In the UK, we have FTSE 100, which are 100 biggest UK companies. In Germany, we have DAX. In Japan, we have Nikkei 225, just to name a few. Stock market growth and decline is not the same as economic growth or decline. However, they do often go hand in hand. So if you want to know how a particular country is doing, you can check their index. Index funds, just like mutual funds, offer you diversification. Index funds have a huge advantage over mutual funds because they offer really low fees. So for example, the S&P 500 index fund has a fee of 0.03%, where mutual funds usually have a fee of 1 to 2%. That is a big difference, especially a long period of time. These fees really do add up, guys. Another advantage, in my opinion, is as there's no person that's actually making the buying and selling decision, the emotional aspect of investing is taken out. One more important thing. All index funds are mutual funds, but not all mutual funds are index funds. So when you're buying a fund, make sure that you check in the investor sheet that it is either a mutual fund and it's actively managed, or it will say that it is an index fund that is passively managed. And then we have ETFs. ETFs are exchange-traded funds, and they were introduced 15 years after index funds. They are very similar to index funds with one major difference. Index funds, you can buy and sell only once a day. With ETFs, you can buy and sell whenever the market is open. So it's like buying or selling a share. Index funds and ETFs are terms that are used interchangeably. However, they are not the same thing. So you need to ask yourself, do you need the tradability that an ETF offers? As humans, we have a tendency for gambling behavior. So if you are a beginner, maybe it's safer for you to go with an index fund. I hope by now you have a clear understanding of what different funds are and what is the distinction between them. So now, how and where do you buy stocks and shares and mutual funds, ETFs? Well, you need a broker. In the old days, we had stockbrokers, a physical person that would place the buy or sell order for you. Now, we have plenty of online brokers, and investing has never been easier. It will differ from country to country as there are many regulations that these online brokers have to follow. In the UK, you can open an investing account with most banks. Other than that, we also have Vanguard, Freetrade, Trading212, eToro, and other different platforms. Some of these platforms offer a stocks and shares ISA, which you should definitely take advantage of. An ISA is an individual savings account that is tax efficient, which means you don't have to pay any taxes on this account. Yes, you heard me right. I will be making a video about ISAs, so stay tuned for that, subscribe and hit the bell so you don't miss that video. So why should you even invest in the stock market? There's something amazing called compound interest, which means that you are earning interest on the principal and each previous year's interest. This is much easier to explain with an example. Let's say you invest £10,000 into S&P 500 index fund. The average stock market return for this fund is about 10% for nearly the last century. Plus, the S&P 500 is often considered the benchmark measure for annual stock market returns. We will adjust the 10% by inflation, so it will go down to 8%. And let's say you leave this money on this account for 30 years. So you deposit it once and completely forget about it and remember about it 30 years later. What will we get? Your £10,000 turn into over £100,000. This consists of £10,000 that you initially invested and over £90,000 of interest. And this is the power of compound interest. Do you get what I mean now? Another scenario. Let's say you deposit £10,000 And every year for 10 years, you deposit another £10,000. What will we have then? Well, the total amount invested would be £178,000. Okay, let's look at this scenario, but instead of 10 years, you will be doing that for 20 years. Not only your money has more than doubled, but the total interest is more than £330,000 with £210 in principal. Okay, so let's look another scenario. Instead of 20 years, you will be doing it for 30 years. And now you have more than 1.3 million invested, with £310,000 being the principal and over 1 million in interest. So what is the conclusion here? Well, compound interest best friend is time. So the longer you invest, the more advantage you can take of compound interest. When you invest for 30 years, the total interest is more than 3 times of your principal. That's pretty amazing, huh? You might look at this and think, wow, this is life-changing. And it truly is, but you won't do anything about it. Why? Linear thinking is so much more intuitive than exponential thinking. If I ask you to calculate 9 plus 9 plus 9 plus 9 plus 9 plus 9, you will be able to do that fairly easily. But if I ask you to calculate 9 times 9 times 9 times 9 times 9 times 9, it won't be as easy, huh? The counterintuitive nature of compounding will make the smartest of us overlook its power and potential. This may prompt us to focus on solving problems with a more linear and familiar way of thinking. Compounding is truly magical and amazing. And again, its biggest ally is time. We need to remember that the most famous investor, Warren Buffett, has been consistently investing for 3/4 of a century. He accumulated 99.7% of his wealth at the age of 52. So, when should you start investing? Well, the best time to invest was yesterday, and the second best time is now. The longer you are in the market, the better off you will be. Instead of waiting for the market to drop, invest consistently over a long period of time. Time in the market always beats timing the market. Just buy consistently. You will buy when the prices are low, you will buy in when the prices are high. And in the end, it will average itself out. This is also known as pound cost averaging or dollar cost averaging or any other currency cost averaging. I invest every single month. However, when there is a market drop, I see that as an opportunity to buy more for cheaper. The stock market will go up and down, and sometimes it will actually be very hard to look at. Trust me, I've been there. But it's very important not to get emotionally attached to this money and think long term. Just buy and hold and start today. Hey, before you go, please subscribe to my channel and join me on a journey to financial independence and lifelong learning. Thanks, guys!